Well, now for a look at what's been making news in markets and the economy, we're joined via Skype by Martin North, Principal at Digital Finance Analytics. Martin, welcome to you.
Good morning.
I actually wanted to start with some comments made by the Reserve Bank Governor Philip Lowe yesterday to that Standing Committee on Economics. And he mentioned contentious issues, certainly in politics, as far as housing affordability is concerned, how to ease that. And he did refer to negative gearing as one particular issue that does need addressing. He said he couldn't quantify the effects, but he said if removed, it could help housing affordability. What did you make of his comments?
Yeah, well, there's no doubt that the investor sector of the housing market has been remarkably strong over the last couple of years, and particularly in the last 6 months. And this has put a lot of upward pressure on house prices and therefore lifted, the amount of mortgages that people need to be able to grab to be able to buy a property. So the investment sector is very strong. If you ask investors why they're going for investment property, it's simple. There are large capital returns, but they're supported by the negative gearing and by the capital gains. So essentially, if you look at comparing ourselves with around the world, we have a much higher proportion of investment holders relative to our market price. So if they were to start moving away, incentives were removed, you could certainly see that there would be some relief of upward pressure on property prices. The debate, of course, is how much will it impact the rental sector, and those issues have been flying around the political sphere for quite some time. My own view is that the rental sector wouldn't be wrecked by changing these tax breaks, and I think the tax break should be reviewed.
Yeah, I mean, clearly the governor there concerned about household debt, saying that it's rising faster than income, spurred on, of course, by those record low interest rates, which is and also low borrowing costs, which is fueling the housing market. So he has some deep concerns there, but also he talks about how difficult it is for the Reserve Bank to act on interest rates, whether they take it higher or lower.
Yeah, it's a really complex set of issues. So let's look at household debt first. We have some of the highest household debt relative to income or relative to GDP around the world. And in fact, around 20% of households today, even with record low interest rates, are close to the edge in terms of making their mortgage repayments. If rates were to rise, that proportion would increase quite significantly. Bear in mind also that income is relatively flat. So in the early 2000s, where we had a rather similar situation, income grew faster than house prices over a period of time, and therefore the debt got more manageable. We're not seeing that this time. So therefore we have this massive legacy of debt sitting there, and it's already cramping people's style and their ability to be able to go shopping and spend money on other things. So if rates were to be raised, and I have a feeling they probably should be raised, that is, of course, going to have an upward pressure on the household budget simply because mortgage rates are going to rise as a result of that. Bear in mind also that the Reserve Bank's setting of their cash rate is disconnected from the rates that lenders actually use when they price their mortgages anyway. So even if, for example, the Reserve Bank decided to slide rates lower, that wouldn't necessarily mean mortgage rates would be lower. So there's a disconnection, essentially, between what the RBA can do and the real life experience of families in Australia.
Yeah, and obviously you mentioned there the problems with raising rates if they were to cut, of course, further concerns about fueling already indebted households, their debt position there.
Yes. Yeah, the issue is that, households have a lot of their debt in the mortgages. Those have a quite high credit card debt as well. And so essentially, if you think about the cost of living driven off the mortgage, but also things like childcare, other things, all the other costs are going up. So effectively, over time, we're going to see more and more pressure on those household budgets, even with low rates. I think we're going to see the mortgage rates rising anyway, because there have already been some out-of-cycle rate rises. I think there'll be more, and that'll be driven partly by the banks looking to bolster their margin and also reacting to the international price of money.
Martin, did you see those comments by the new Planning Minister in New South Wales, Anthony Roberts, who said during the week, once you're in Sydney, if you're in the housing market, you're pretty well set for life. Do you think those comments were helpful?
Well, I think it's it's sort of okay if you're in the market, but it's very hard to get into the market, right? So it's interesting that in New South Wales, around half of first-time buyers can only get in the market if they get help from their parents. So that's a remarkable and rising number. If you're in the market, then you effectively experience massive capital gains over a long period of time. But remember, of course, house prices can go down as well as up. And the problem we've got is if we start moving the dials and lifting interest rates and reducing demand from investors, then house prices might move the other way. And if they did that, the negative impact on perceptions of wealth and the amount of money in people's bank balances would be quite severely affected. So this is a very complicated, very difficult issue. I have the view that we've got a long-term systemic issue around house prices. You cannot fix it with just a few tax changes or moving the interest rates around. It needs a much more structural review, looking at supply, looking at demand, looking at how we help people get into the market for the first time, help people to move up and down within the market, think of things like stamp duty as well. So there's a whole bunch of issues that I think that need to be looked at. The problem is that no one entity across the whole country, be it federal, be it state, has control of this. It's multi-parties, very complex political agenda, and therefore very difficult to make progress.
Martin North from Digital Financial Analytics. Thanks very much.
You're welcome. Thanks.